In the ever-evolving world of semiconductor manufacturing, one company that has consistently found itself in the spotlight is AIXTRON SE. Known for its cutting-edge deposition equipment used to create compound semiconductors, AIXTRON plays a crucial role in the global tech supply chain, particularly in fields like power electronics, optoelectronics, and 5G infrastructure. Recently, the company released its latest earnings report, and while some numbers impressed, others suggest 2025 may be a challenging year. Let's break down the numbers, the forecasts, and what it all means for AIXTRON stock moving forward. Solid earnings, but a cloudy forecast. AIXTRON gave investors a reason to smile with better than expected Q1 2025 results. The company's revenue reached €113 million, about 9.1% higher than analysts had predicted. Earnings per share, EPS, came in at 4 cents, beating expectations by 7.7%. This type of performance often boosts confidence in a stock, and for good reason. It shows a company's ability to outperform even in uncertain markets. Despite this upbeat quarter, analysts are cautious about the future. Consensus estimates from 14 financial analysts suggest AIXTRON's revenue will drop 14% year-over-year in 2025, settling at around €542.4 million. EPS is also expected to fall by 21% to 70 cents. That's a sharp decline, especially when compared to its strong track record of 21% annual revenue growth over the past 5 years. Why the cautious outlook? One reason behind the bearish forecast is the broader industry shift. While demand for semiconductors is still strong globally, the market is becoming more competitive, and some sectors like consumer electronics are seeing slower growth due to economic headwinds. AIXTRON's specialized equipment is critical for producing next-gen semiconductors, but if clients cut back on new investments or delay orders, it can significantly impact AIXTRON's bottom line. Additionally, analysts expect other companies in the same industry to grow revenue at around 8% per year, while AIXTRON's revenue is expected to shrink. This divergence has raised questions about whether AIXTRON is losing ground to competitors or simply facing temporary market challenges. What do analysts think? Despite the projected revenue decline, analysts haven't dramatically changed their stance on the stock's value. The average price target remains steady at €14.80. However, there's a wide range of opinions. Some believe the stock could hit €22, while others see it falling as low as €9.80. This broad spread suggests a lot of uncertainty about the company's future direction and potential. What's interesting is that analysts didn't make any drastic revisions to their earnings models after the Q1 report. That typically indicates that, while near-term challenges exist, the company's long-term fundamentals remain intact. In other words, the market might just be waiting for AIXTRON to prove it can bounce back. A stock at a crossroads. AIXTRON isn't a falling star, far from it. It's a company in transition, facing a slowdown after years of rapid growth. The key question now is whether this pause is a temporary breather or the beginning of a longer trend. Investors should pay attention to how the company navigates this year, particularly whether it can maintain margins, win new contracts, and continue investing in R&D to stay ahead of the curve. A strong second half of 2025 could easily change the narrative and turn sentiment more bullish. Conclusion: is AIXTRON worth watching? AIXTRON's recent earnings beat shows it still has operational strength, but the road ahead appears bumpy. With revenue and EPS expected to decline, and a wide range of analyst opinions on its stock price, the company is in a period of recalibration. However, with a foothold in high-growth sectors like 5G, electric vehicles, and laser technology, AIXTRON could still surprise on the upside. For now, it's a stock that deserves a spot on your radar, especially if you're the kind of investor who sees opportunity in volatility.